Hello and welcome to our next session. In this one, we're going to look at some of the December 2014 multiple choice questions. So we're looking at the December 14 paper. In this session, we'll look at questions 1 to question 5. Now, you'll need to have a good understanding of various different areas of the course. That's why we leave these multiple choice questions until the end in our revision, because we want to just make sure that we can deal with all aspects, and these multiple choice questions can do that. They can cover every area of the syllabus. So what I'd like you to do here is to work through these one by one. You have a go at the question and then we'll go through the answer together, because it's as important, as we've said, to learn from the answer as it is to get it right. So even if you got it right, it's worth looking at the other bits to see why you got it right and why the other aspects of the question maybe were wrong. So we're going to start with question 1. So have a go at this and then we'll work through the answer together. So the dividend has just been paid of 21 cents per share. Share price 1 year ago was $3.10 and the total shareholder return 19.7%. What is the current share price? Well, we know that the total shareholder return is 19.7%. So if the share price was $3.10 1 year ago, add 19.7% on and you get $3.71. So that's the share price after the return, and it would be tempting to go for that answer. But remember, the return includes two aspects. It's made up of share price growth and it's made up of dividends paid. But the dividends paid won't be part of the share price growth that we see. So what we need to do is strip that out to get the current share price. So the growth would take us up to $3.71, less the dividend that was paid to get just the share price growth, and that will take us to $3.50. So that is answer A. So that's what we needed to do. The total growth is the share price growth and the dividend. So get the total growth, take away the dividend, and that gets you just the share price growth. Okay, so let's have a go at question 2. Again, have a go at it first, and then we'll work through it together. So here again, we need to go through each one of these and decide whether we think it is correct or not. And this was a little tricky because the terminology is not always easy in these. So looking at 1 first of all, well, it is correct. Even if you didn't know that, you could maybe work it out by thinking, well, securitization, that means you're putting security onto something, which makes it more secure. And that is the conversion of illiquid assets into marketable securities. Well, if something was illiquid, it means no one wanted to buy it. If we securitize it, well then they may want to buy it, and that would make it marketable. So that's what that is getting at. So 1 is correct, that will make them marketable. Now, even if you didn't know that, look at 2. 2 is incorrect because it says the reverse yield gap refers to equity yields being higher than dividend yields. Well, we know that equity yields are higher than dividend yields, but that wouldn't be a reverse yield gap, that would be a yield gap. You get more yield or interest on equity basically. I know it's not interest, it's dividend, but the yield covers both, than you do on debt. So that's the yield gap, not the reverse yield gap. And looking at the answers, if you ruled out 2, well then A couldn't be right, C couldn't be right, and D couldn't be right. So you were left with only one answer, which is B. So if you could work out 2, that would get you the answer to this one. Just finally, 3 is correct because disintermediation is the removal of an intermediary. So rather than working through an intermediary like a finance house, which we mentioned in our lecture, you'd remove that and borrowers would deal directly with the lenders. So that means, as we said, the correct answer here is B. Okay, so what about question 3 then? Which of the following statements is correct? So have a go at this one, see what you get, and then work through the answer with me. So, which of these are correct? Well, looking at them, number 1, maximizing market share is an example of a financial objective. Well, that's pretty clearly not correct because that's a non-financial objective, maximizing market share. 2, shareholder wealth maximization is the primary function or primary financial objective of a company listed on the stock exchange. Well, yes, we know that. That is definitely correct. That is the primary objective of all organizations, or at least profit making. And 3, financial objectives should be quantitative. Yes, they should. So that's also correct. So that means that 2 and 3 are correct, which gives us answer C. Okay, what about question 4 then? Now this one will take a little bit of calculation. So once again, do the calculations, work it out, and then work through the answer with me. So this question relied on you being able to do your money market calculations for a hedging, and starting here we need to think, is this a payment or is it a receipt? Well, looking at the first line, we expect to receive 500,000 pesos in 6 months' time. So what do here? We borrow the money in pesos for a receipt. We make the transfer now. So that means we transfer at the spot rate. So don't use the forward rate. And then put this on deposit in dollars to earn interest. So working through that process, the 6-month peso borrowing rate, because we're going to receive it in 6 months' time, is 4%. So it's 8% for the year, 4% for 6 months. So that means we're going to borrow 500,000 discounted at the 4%, because remember, we borrow it over there, we'll incur interest on it, and that will take us up to the 500,000. So we borrow 480, we have 4% interest on it, so we owe 500 at the end. We transfer that home now, so we do it at the spot rate, which is 15, which means we transfer home $32,000, and then we put it on deposit in the dollar rate, and that's 1.5% for the 6 months. Add that on, and we get 32,532. So add on 1.5% for the interest, 32,532, say 32,500, which is answer A. So that question relied on you being able to do those calculations quickly, and you should be able to do that if you practiced enough. If not, make sure you go back and review this area, because although it looks technical, it's actually very easy once you've done a few of them, because they're basically all the same. Moving on then to question 5. Which of the following statements is correct? So again, you have a go, see what you get, and then we'll talk about it. So moving through these one at a time. First of all, answer B I've said is correct already. Let's see why. A doesn't raise finance because it's a bonus issue. So a bonus issue is where you issue shares in return for nothing. You give them to your current shareholders for nothing. So that's not going to raise finance. Incorrect. B, I've already said that's the right one. It is correct. Why is that? Because if you repurchase shares, that means there's less shares. So that will increase earnings per share. So less shares, same earnings, better earnings per share. And gearing will also be increased because less shares, same debt. Well, that means that you've got more debt, less equity, and gearing will increase. So B was correct, but let's learn a bit as to why C and D weren't. So C, Miller Modigliani, well, they said actually that financing is irrelevant. That's thinking about your capital structure theory. They basically said regardless of capital structure, the company will be at the same value, so it's irrelevant. And they said that dividends were irrelevant, so they said both were equally irrelevant. And for D, well, they don't. Shareholders don't have the power to increase dividends at the AGM. That can't happen. So B here was correct.